I'm sitting here with my good friend Jim Hogle. I've been working together for over a decade right now, right? Is that correct?
Yeah, 12 years.
He's the only guy I trust when it comes to credit stuff. I think we met through the marketing animals, right? Carl,
I believe that is correct, yeah.
I'm not sure if you know this, but when he started the Freedom Club, I was one of the first 7 that they picked when they started that coaching.
Oh my gosh.
Now it's 10 years later. It was funny because they were only limited to 7 people at that point. So I got in somehow. I did a video talking about about my history, and they picked me. So I think that's how we met eventually. I think you came to one of his events and you spoke. So appreciate you over these years. I know you really helped our team, helped me personally, family members personally. When I recommend you, I always say, hey, listen, he's not only helped clients of ours get into a home or change their life around, he's actually helped me, myself, my family members, and so forth. So just thank you for all you do and for being on here. So
Love it.
let's talk about your background. How did you get into the credit repair business? Let's start from the beginning, talk about before, what you did, and how you got into this.
All right. Well, when I met Gregg, I was in the mortgage business also with Carl White and some other people. For about 15 years, I had my own company in Indiana. And then when 2008 and 9 hit, we basically crashed and burned. I lost everything like a bunch of us. And then I decided to reinvent myself. I said, well, I'm going to help people with their credit. And because I had fostered all these partnerships with all these other, people such as you in the business, they just reached out to me, and then it kind of took off from there. Now I consider it my personal mission just to help people with their credit. I mean, we all go through life-changing events. I mean, things happen, job loss. We got a lot of identity theft now. People have a 30-day late will just crash your scores. So it could be a medical issue, car accident, loss of a loved one can change your life. So those things happen. And I just want to reach out to those people, let them know we can get them back to where they were.
I always have respect for people who were in the mortgage business, who stuck around in the mortgage business in any capacity,
Yeah,
It's still part of it going through that crash, because that was a nightmare. Absolutely.
yeah, it was.
Let's dive into it. I know we've got some questions we're going to type into it. So what is a FICO score, and what does it measure?
The infamous FICO pie chart.
I send this to a lot of clients who are paranoid about their credit being pulled, so I want to touch on that point too. So,
Okay. So this is FICO, just some trivia for you guys. FICO stands for Fair Isaac Company. The 2 guys that developed the algorithm, one's named Fair, one's name's Isaac. So that's where this came from. Fair Isaac Company. So FICO, that's where it came from. This chart can always be found on the My FICO chart or website. What I wanted to share on here is when I go through your client's credit reports, the first thing I do is I separate the good credit from the bad credit. And I say, well, are they paying everything on time? 35% of the score, number 1. Number 2, do they have a credit card? 30% of the score is revolving debt, which is having one credit card. So I kind of cover their good credit first, because that's 65% of the score. And then the other pieces are smaller, but they're important. But then usually it's derogatory information that's hammering their scores.
question. So, a lot of people get nervous about them pulling the credit score, right? And I always chart, and I show this to them, right? So
Yeah.
that affects somebody's credit when it gets pulled. I know it's different circumstances. There's a lot of other factors, but that's not even part of this pie chart, right?
Yeah. So pulling the credit it can be, most of the people pull them online. They're a soft pull. My FICO is a soft pull. In fact, it's the only place that I know of you can get all your mortgage scores. So I'm going to show you my FICO actual report next, so you guys can see all the scores. Because a lot of people say, where do all these scores come from? Why isn't my score the same? But the ones you pull online are typically Vantage Score 3.0 or FICO version 8, which is not your mortgage scores.
Gotcha. Best place I tell people to go if they want to pull their scores is myfico.com, pull the tri-merge, correct?
Correct. And that's it. And then that's what we're going to take a look at, because a lot of people don't realize how many different scores are out there. All right. So if you go to MyFICO, the first 20 pages of this report are all different scores. So the first one that comes up is FICO version 8. This is the one that they give away if you get FICO score online, is FICO 8. But there's actually versions 2, 3, 4, 5, 8, 9, 10, and 10T just came out. So there's all these different versions, and you have 4 scores. You have a generic score, credit card score, automobile score, and a mortgage score. So when your car dealer pulls it, and they only pull one bureau, and they pick which one they pull, it's a different score. It puts more weight on your old car loans. So all these scores are different. So when people pull them online, they always wonder why my scores are different. That's why. So it's pretty convoluted, but I just wanted to show you some of these. There's another FICO 8 on this report, and I got these pages segregated here for you. There's 542. Now these are the person's mortgage scores right here. And there's an auto score 8. A lot of the dealers are using auto score 8 and 9 now. And then there's an auto score 542. Those are old. These versions actually go back to the year. This is 2002 version, 2004. I mean, these are 18 to 20, 15 years old. It's crazy. And the mortgage businesses never update them, but they're going to update them. There's your bank card. That's your credit card score. There's FICO 9. There's a FICO 9 card score. So you can see why people get confused. There's an old FICO 3. That's 2003. I don't use that. And here's 10. Now 10 just came out. We're going to touch on this at the end. FHFA is going to start using VantageScore 4.0, and this is going to be your new mortgage scores. And that's supposed to happen this year. So what's crazy about this, and I started tracking the clients that are pulling these, this mortgage score that you guys are using right now, the one that we just saw up above, this one was 553. This one was 600, exactly identical. And this one, no, this was a 548. It was lower. It's crazy. So I'm trying to track what the hell's going on with these scores. That's a 548, and then this one was a 621. So these things are really going to bounce around. So I'll cover some of the details of what's going on so you guys can understand that. But that's kind of what goes on with the scores. When they pull it, they're always different.
So quick thing, I mean, what we deal with is we have borrowers say, well, like my credit score, don't pull my credit score, don't pull my credit score. I checked on Credit Karma, right?
Yeah.
Which is always way, way off than what we need. So where does Credit Karma come into all this?
Credit Karma is a VantageScore 3.0. They can be 50 to 100 points higher than a mortgage score.
I know, that's what.
So they're not even close. Yeah, VantageScore has 6 criteria, FICO has 5. And I will also share this with you. The mortgage scores always score higher. A lot of people don't know what the whole algorithm is based on. The FICO algorithm is based on the likelihood of a client getting a 90-day late in the next 24 months. So the FICO guys developed the whole algorithm of what are the odds of you getting a 90-day late in the next 2 years. That's what the whole thing is based on. Fair and Isaac. So, but the other thing I tell people when we do the personal reviews with them and create an action plan for them is the reason these scoring models are different is because it all depends on the list to the lender, to the bank. So if you're buying a piece of furniture for $2,000 and you get a year loan on it, you're using a generic score. If you're buying a car, you're spending 10 to 50 grand, 5 to 7 years. You get a home, hundreds of thousands of dollars for 30 years. So the risk to the lender is higher. So they're looking for more credit, less lates over a longer period of time. That's why those scores always score harder.
Adding an authorized user to report help and help with the credit score, and how many accounts do you need to open to generate a score?
You can use just one to have an authorized user. And a lot of people will open a whole bunch. You get on Credit Karma, and then they open a ton of credit cards, and you really don't need to do that. You could do it with just one. So one card will do it.
So, all right, so let's authorize user to report help. How much is this help? What should people do? How long does the authorized user have to have credit for it to help?
Yeah, I prefer if they've got 5 to 7 years on a card, that's a good amount. Having a card is 30% of the score. Credit history is 15. So you can actually affect 45% of the score if you add a authorized user. And I actually did this with my son when he turned 17. He wanted to buy a car. I told him I wouldn't co-sign. So I did a credit card, authorized user card. And then after he got the card reporting in the next 40 days, he applied for his own card. 3 months later, after he paid on time, he got his own car loan. So it took him about 9 months But that initial card with the history can immediately give you like 650 mortgage scores right out of the gate.
Gotcha.
And you can do it with one card.
So with the authorized user, it can help, obviously, it can help them increase their score. And like you said, just like you did with your son, how much does a new 30-day late or collection lower somebody's scores?
It can lower scores 50 to 100 points is what I tell your clients. I had one client with an 800 score with a little medical bill, $57. It lowered her score 180 points. So the higher your score is, the more it affects you. If you've got a 600 score and you get a 30-day late, it might hit you 50 points. If you're 750, it can lower your scores 100 points.
Wow.
And yeah, your credit is a snapshot in time. So if you change the picture, you could change the score. If you get that 30-day late off for goodwill, or if it was in error, and it comes off and you can re-pull the credit and it's immediate. Your scores will jump right back up where they were. So a 30-day late or a new collection score is the same. And here's a couple other tips for you on how the algorithm works. There's basically a major derogatory and a minor derogatory in this credit scoring where it tags you. So a minor derog is a 30-day, 60-day late, or a new collection. Those are all minors, 50 to 100 points. Anything above that, if you get above a 60-day late, a 90, 120, 150, all scores the same. Bankruptcy, foreclosure. That's a major derog. It's 100 to 150 point hit.
Yeah, I mean, that's something that I've seen it happen. It happened to me. I think we worked together probably 7 or 8 years ago. I had a small medical. It was about $7. It was, I think it was like $50 and change. And for some reason, so would somebody need to get something off their credit like that? Let's say the insurance company should have covered it. They didn't do that. Okay, now they have to get it off their credit. What's the process?
Yeah, well, the new FICO 10T, which we're going to cover in a second, so that is going to fix all this. And the reason that the Vantage scores are higher, version 3, and version 4 is going to fix this too. Any paid medical debt can be deleted. In fact, it's happening this year. That can be deleted. Okay. So if you settle it, it can be deleted this year very easily. And actually, any paid medical debt can be deleted. So they kind of fixed that this year. The bureaus agreed to do that.
Gotcha. So what kind of documentation do you need for it to be deleted? I mean,
you really don't need any. I've got a press release from Equifax, Experian, and TransUnion. All of them signed off on it. In the first 6 months of this year, any paid medical will get deleted.
Really?
Yep.
Okay.
I can send that over to you and share it with your team.
Yeah, that would be great if you could.
It's a press release straight from the bureaus. Yeah. So we can dispute those right out of the gate. And these are unpaid ones. So if it's under $500, they've all agreed to remove them because they're tagging people's scores a lot. And people know it's usually a one-time incident.
Yep. Let's talk about above 500. Can you do anything with that?
Above 500, it just depends on how old it is. So collections, here's how I look at collections. When I go through a person's collections, there's a whole bunch of dates on the report. There's an open date, reported date, date of last activity, all this crap. The only date that matters on collections is the date opened. So you want to find the newest negative item on the person's report if you want to increase your scores short term. So that's what I look for when I go through one of your clients' reports. If a collection gets resold, the open date is updated to the day they buy it. So an old collection can retag you over and over and over. So if they got a bunch of collections, I go through them and I look for the open date and say, you want to settle one that's going to make a difference? It's that one right there. I can help your clients get to the point where they get their home loan. It's just more precise.
How much does a 30-day late or collection lower your scores? We talked about that already, but how can we help our clients even after closing?
There was a new release that just came out on car insurance. So I've got a couple of people doing this. If you guys close a loan and you see a client's score, one of them's low, or you notice they're a little bit lower, or they could still be higher, send them over to us. We'll still do the free review. Car insurance has gone it's skyrocketed like 10, 20, 30% in some states. But we have a lot of your clients, after we start the credit restoration, they'll refinance their car. But the other part of saving $100 or $200 on a car payment's part of it. You could be paying $50 to $200 more for car insurance per month if you have low scores. So if you guys want to help your clients long term, and Greg, you know this, a lot of people refinance their homes or they turn that mortgage over in 7 to 10 years. So you want these are lifetime clients. So if you can help them after they close their loan to get their scores even higher, save money on the car loan, save money on the car insurance, it's huge. But I can send you that report too. It just came out. In the state of Michigan, they said a low score versus a high score, $468.
Wow.
It was crazy money.
That's a great idea. You know what I'm saying? We can help them, get to a point where, hey, it's not just, okay, we do the loan. And I always preach this too. We got to stay in front of our clients because they normally buy or refinance 4 to 7 times the lifetime. Sometimes they don't, and they're not, especially with people moving around as much as they do now. So not only that, you can provide a service to them and say, hey, listen, we got the house, but let's get you in a better position here so you can get better insurance, quotes and help you save money on top of that. We have a client now that we're closing and basically, doing the same thing. Is okay, let's get the house and let's work on credit. And then we can look at seeing if we can redo the mortgage, if it makes sense to do it, because all indicators point the rates coming back down a little bit. If that doesn't make sense now with this, obviously we can help them with their home insurance and save them that way as well. So it's great.
Yeah, the review is free. So just offer them a free credit review and say, hey, look, we know we can save you more money. Talk to Jim. Yeah, and do a free review. You look like a hero.
Yeah, that absolutely. I mean, you always want to, especially in this day and age, you want to provide as much value as possible. So having you on I call you a team member pretty much,
Yep.
So everybody, hey, our team member Jim is, somebody that can help us, get you in a position to purchase a house. But not only that, just what you talk about, home insurance. What's the biggest pushback you see if we send somebody to you, right? But they don't go through with stuff for some reason, whatever the reason is. They don't think it's going to help them. They don't care. Well, they've heard from Credit Karma and that. There's another thing. What's the biggest pushback to that? And what do you provide as far as information? I kind of know what it is, but I want everybody else to know. I to them to say, hey, if you do this, then you can go here.
Yeah. What we do with your clients is and very few companies do what I do. I take the time to teach them about their credit. So when we go through the credit, I'm going to say, let's look at your good credit. And I'll explain to them exactly what I shared with you. You need one installment loan, at least one credit card. Let's get that going. And I tell them, this is the only thing that drives up your score is your open good credit. That's true. Derogatory items are the only things that drive them down. So I kind of segment it for the client, and then they understand, I don't need 10 credit cards. Credit Karma keeps telling me to get another credit card. I don't need all those. So I give them, I said, make your life simple. If you want to close some of the cards, here's the good cards. I tell them the subprime cards, get rid of these. So I actually coach them through and teach them about their credit. No one does this. And then when I'm done, I send them an email and I copy you guys. And it's basically their personal action plan. Here's what you guys need to do. Because credit restoration is really the client paying their bills on time, number one, and then no new negative items. So even if you've got a brand new 60-day late, your scores will come back up, and it's going to take 3 to 6 months. So even if I can't get that off or new collection, your scores will recover in 3 to 6 months. So it's a time thing for most of the clients. And of course, when they come over, they want to buy a house now. Hey, I just found a house. Then they come to you, it's like, I want a loan today.
Yeah.
And then you send them over, and I kind of burst their bubble, and I go, well, you got some issues here that, because I tell people that this stuff didn't get on there overnight. It's not going to come off overnight. It's usually a 2 to 3 month process, but when we're done, it still could take a couple more months and just time.
I think that's the one thing. I think, we had somebody in my office the other day, it was Seth, talking about one of the big things we really love about you is that you'll sit down with a client beforehand and say, listen, you really don't need to go into our services. If you just do this, this, and this, that should help you. Nobody in the industry, in many industries, ever do that, but you always look out for the client first and foremost. Hey, what's the best thing? Instead of getting into our program, you counsel them and help them and guide them. And sometimes they don't even need to go in the program. They just follow.
Yeah, and I think maybe I give them too much information because then they think, well, I'll just do this. I don't need to dispute it. Yeah. And that happens. But then they call back in 3 months. But I have clients that call back 2 years later, and they just keep plodding along doing what they're doing. But you have to remember these clients usually have had historically derogatory stuff on their credit for years. So it's a changing of a lifestyle too for some of them. But I'll take them, bankruptcy, foreclosure, divorce, send them over. I'm all about helping people.
Let's talk about if somebody has to get into your program. I know the costs are different depending on circumstances and situations. Would you want to touch on that if somebody comes into the program?
Yeah, sure. We have a flat rate. Basically, the initial round is $207. After that, it's $117 a month. They only need to stay in as long as they need us. But basically, credit restoration can't go on forever. When everything on a credit report is verified it's theirs and it's 100% accurate, we're basically done. Then it's up to the client. Do they have money to settle some of these accounts that are really tagging them? And if they don't, then I tell them, leave them sit. There isn't any reason to get into a payment plan on a collection. And really, you have to be careful doing that because you reset the 7-year clock for deletion. So if your client's got a bunch of accounts that are going to come off in a couple of years, they don't have money, I say, don't call them if you don't have money to settle. And just let time do its thing. But then at least they know in their head, oh, this is what I have to do. Because no one knows what to do when they come over to us. That's the hard part.
I'm always amazed, right? People want to buy a house. They get all excited. Now they can qualify. We've set them to you. And those are, I'm sorry, those are ridiculous prices, okay? I'm not saying raise them or anything else, but I'm saying what you provide for them to get into a house where they could gain appreciation and the thousands of dollars that they can make off that house over time is absolutely ridiculous. Look, sometimes we have clients that don't want to take that first step. And it just, to me, it just blows me away. I don't get it. I don't understand. Do you really want the house or not? It comes down to that,
Yeah, and if they look at what they can save on car insurance, I tell them is you don't even know what you're paying on your car insurance, but I see their car rates, what the payment is. I said, you're going to save $100, $200 on your car payment. I can probably save you $50 to $100 on each car per month on car insurance. I said, you need to bite the bullet, invest in yourself, and let's get it fixed to save a bunch of money. This is the new Vantage Score 4.0. So this is what's coming at you guys. So FHFA, Federal Housing Finance Agency, has approved FICO 4.0 and 10T. All right. So here's the skinny on this, and I can send this over to you, Gregg.
Please do.
That's our little tagline there, restoring America's financial health, one family at a time. That's kind of what we do. All right. So here's the skinny on this. Vantage. As soon as they get this into your guys' system for automated approval, your clients, and I don't know how they're going to work this, Gregg, they're going to have a choice of using FICO 10T and for the first time, a Vantage Score 4.0. So both of these are getting worked into your software right now, and that's what's holding it up. But T means trended data. So what it's basically measuring is on their credit cards, do they pay them off every month or are they revolvers and carry a debt every month? That's all that is. What they found is the people that paid off their credit cards every month have better scores, less likely to have a 90-day late. So they started measuring all that. But here's some of the differences in 10T. Paid off collections are ignored. So even if they're on the report, if they settle these, they're not going to get scored. That's huge. So now I don't have to worry about getting them deleted. That's a lot of work. Collection accounts related to medical debt have less of an impact. They already fixed that this year. That's happening right now. And the bureaus took it upon themselves to fix that. I'll send you that flyer. Rental payment history is considered when included in a credit report. I just got a link set up, and your clients can use this. I send it to them with their action plan where we can report rental history. So we've got that done. So your clients can add that up. They can go back up to 24 months.
So let's stop right there. So what exactly do you need for rental history? You just need a VOR, completed verification of rent form completed by the landlord?
Yeah, I got a link. All I got is I got a link set up, Gregg. All I got is click a link. They put their information in there. And of course, we want on-time payments on the rent. Don't add it if you got lates, everybody.
Yeah, that's something that we don't want to add. So,
but you go back up 24 months and add that to a credit report now. All three bureaus, and I just got set up to do it. So I got a link for that. Yeah, it's pretty cool. and the client can do it. I think it's $100. If you want 2 years, it's $200 or something like that. There's FICO 10 and 10T. T's trended data analyze the past 24 months of balances and payment activity. So they're looking for, do you carry a balance or do you pay your cards off? Recent late payments may be penalized more harshly. So this is going to be key, Greg, because that 30-day late that used to be 5,200 points, they're saying in this model is going to tag you even more. So that's going to be something to look out for. And FICO 10T still has the 5 major scoring components to what we looked at in the pie chart. So it's not going to change. If you use Vantage Score 4.0, I've seen the Vantage Score 4.0, but I haven't seen it with a mortgage score yet to compare them. It takes 2 years to develop data on a scoring model. That's true for FICO or Vantage Score. So they measure all this data for 2 years. It has 6 components instead of 5. This model will use trended data, not just on the credit cards, but other loans too. So I don't know how that's going to work because no one pays off their car loan every month. So it's going to be mainly credit cards. Do you pay your cards off? This version, they say, will score 40 more million consumers. So where the old models didn't score someone with a thin credit file, these new models, Vantage Score with this 6 component, is going to score more people. You may get people that before, when you had a thin file, didn't have a mortgage score in FICO, may have one in Vantage Score.
Let's say, okay, we add a rental score and so forth, but let's say they don't have rent, but can they add a cell phone bill or anything else? And does that affect the score? And how much does that affect the score usually if somebody's got no credit?
If they have no credit, I don't usually recommend, just add one installment loan. Now, those types of payments right now, Experian Boost is the only one that adds them, but they only go on Experian. So I don't even mess with them. And I was told this, Greg, here's a good question for you. We had a couple clients that had like a $400 cable bill. If that's on their report, do you guys count it when you're doing their debt ratio?
Yeah. I mean, so if we can use that, I mean, if it's on there, I believe that we have to count it. But what it does is, if we have to go alternative credit, then we can use that. You know what I'm saying? So
okay,
there's some things that we can add it to the credit report. So for that particular person that we need to use different types of credit because they don't have the history, so to speak, we can use that to our advantage. Obviously, if they paid everything on.
Right. Yeah. So what I do with those clients, I get people all the time on Experian Boost now. They've added 4 things. I said, keep the 2 little ones to Netflix, $17. Keep the little ones and get the big ones off because installment loans barely move the needle, and it's only Experian Boost, so it's only hitting 1. So for your big hits on your credit scores, if they got a thin file, authorized user, and then get them another card, and that's it. If you want to add history, because that's what it's going to really boost the scores. So the FICO versions 2, 4, and 5, finally, these are old, 5 to 18 years old versions. These things are going to go away. And soon, hopefully by the end of the year, you guys are going to be using FICO 10T and Vantage Score 4.0. And here's what's kind of holding it up. They said, and this was last fall, I was at the FICO conference. This is coming straight from FICO, by the way, a VP. It could take 12 to 16 months to integrate these new models into Fannie Mae and Freddie Mac software. So that's the only thing holding it up.
So we figure by 2023, it should be all locked in and all integrated fully. If you had this conference, last fall, so, or sometime this year,
Yep, sometime late this year, yeah, see. And then you might start seeing it on reports. They might start pulling both so you guys can monitor. If a client's pulling my FICO report, which I showed you guys earlier, I'm starting to track these now because I'm seeing scores sometimes 50 points higher, 50 points lower, just like we did. And I'm going, what in the heck is scoring different? I think if it's these collections, somehow that's scoring these different, these paid off accounts are not counted. This is going to be huge.
If somebody wants to come to you, obviously, if they get, if they're one of our clients, we kind of know what to do. But if somebody's not and just, hey, I'm not getting a mortgage here, but I need help with something, what's the best way for people to get contact with you?
They can just send an email over to info@usccra.com. My staff gets those, and then, we'll handle it from there. We'll get a hold of them. And if they don't have a credit report, that's okay. We'll send them to a place to get one. And then I'm actually looking at rolling out a new service where the clients can do their own credit repair if they don't want to pay for ours.
So with, with the future coming up, anything else that we should know when it comes to credit scores, credit history, trends that you see and going forward or from your history?
No, these are the biggest things right here on this page. And I'll forward this over, Greg, so you can share this with your staff. This is a 2-page memo I kind of put together. Okay. So I'll share this with you. But really, the FICO 10T is the biggest thing. And I think the under $500 medical bills, we're going for a full deletion on all those on every report right now.
Jim, I always appreciate you. I mean, your customer service is second to none. Like I was telling people before, I mean, you give free advice all day long.
Yes, I do.
Personally, I think you should be charging for it, but hey, I think it's awesome. It's part of your spirit. It's part of helping other people. You run around to you either way. We have the same philosophy too. Hey, let's at least give them some advice, whatever, help them. If somebody can't, get a mortgage now, we have 2 ways of pointing them in directions here. If we have to do a rapid rescore, that's one way. If they're pretty close, if not, then we hand them to you. And then your staff has been phenomenal over the years. So I just want to say thank you for all you've been doing. I mean, it's 12 years now, right?
Yeah, I've been doing this since 2009. So, man, it's kind of my mission now.
Well, I appreciate it. So if you need anything, please let us know. Anybody else have questions? I got one more here, Q&A.
Okay.
How does a debt consolidation program affect credit? Great question.
I go through a whole scenario with your clients on the phone if they're looking at debt consolidation or if they've just entered. I have a couple of companies I recommend, but if a client's in the position, they can either entertain bankruptcy or the debt consolidation. Most of the debt consolidation companies will advise your clients to default on all their cards. Their scores are going to get trashed. They don't always tell them that. Here's what happens. They go 30, 60, 90, 120, 150. They charge off the collection in the next 6 months. Then, while you're giving them money in a trust fund every month, they're saving it up, and they're going to go in and settle each account one at a time. That's basically what they do. It's a 3 to 5 year program. During that time, your scores are trashed because you're going to have all those lates and you're going to have defaulted cards. Here's another big tip for you. I forgot to share this. If you have a defaulted card on your credit cards, the algorithm always compares your balance to your limit and does a percentage. That can lower your score 60 to 80 points. When I look through a client's report, one of the things you guys always do is tell them to pay down your cards. You want your balances low. Here's the big secret. On charged off credit cards, they still count in that ratio if they're less than a year to year and a half old. So if they've been charged off in the last year, those are upsetting their balances on all their good cards. So I have to look at that too. So that kind of screws up the client's cards for a year and a half. Even if they get a new credit card, if they're in debt consolidation, those charged off cards are all over 100%. It's crushing their scores. So that's the problem. It's a 3 to 5 year payback. So here's what I tell your clients. If you want to do this yourself, I will tell you how to do it yourself. Because if you're going to default on your cards and let them go, I said, well, can you pay 1 or 2 of them? So default on these if you're going to choose some and save these so you got your good cards. And then when they charge off, you call and settle them. And you can settle them for 30 to 50 cents on the dollar once they're charged off and sold to a collection company. And you're going to take the hit either way. I'll counsel them through it, but they got to know, man, their scores are going to get trashed.
Yeah, and that's, you're exactly right. I've talked to a lot of clients who've been through all that, and they just weren't told, they don't know. And,
yep.
And so forth. So that's great advice. Great advice, especially with them doing it as well. Another question here, using a credit card only once every 3 to 9 months, I've noticed using one of my lesser used cards, the Lowe's card, seems to drop my score even when the balance is kept below 10%, paid off in full when the statement comes in. Is this true?
That I'd have to see your report. That shouldn't affect anything. I tell people if you got 3 or 4 cards, if you're building your scores, you want to use them, but you can just use 2 of them. So if you got 4 and you only want to pay 2 a month, that's fine. And then they'll cancel them in 3 to 6 months. So if you don't use them, they can cancel them in a year. I use it. Yeah, I would use them every 3 to 6 months, but that shouldn't lower your scores. The only thing that'll lower your scores at 60 to 80 points is if you put a high balance on a card. So a $300 card, and you put $250 on it. I've seen scores drop 60 points and people are freaking out and I go, there's an 80 point spread there. So it can really affect your scores. It's crazy, but it is. There's that much value in those.
It's so funny because everything that you've talked about, right, that big pushback we get is, once again, I'll start from where we started the conversation. Don't pull my credit because I'm worried about going down. If they're not paying the bills on time. They're not worried about that. They worry about us, right? So
Right. Yeah, 5 to 15 point hit. So yeah, don't worry about that. Well, they can always do a soft pull too. So all the pulls online are soft pulls.
and there's always a way to bring it back right back up to you if you had to. And
Yeah.
so you tell them that too. We'll coach you through it. But too, we see everything. What we got here, So,
That's true.
got a client with only 2 installment loans on their credit report. No revolving, but scores in the 700s. She is looking at paying one of them off to her lower DTI. Do we need to worry about hurting her score?
No. Installment loans barely move the needle. So go ahead and have her pay that off so she can buy more house. If she wants to supercharge her scores, have someone add an authorized user, they might jump another 50 to 100 points. The credit card literally is 35% of the score. It's 180 points in the algorithm. So if they can put an authorized even on that kind of an account, if they got a 1 or 2 year history before you guys do the home loan, if it benefits her, it'll hit in the next 30 to 40 days.
So next question is, do you suggest borrowers paying off collection accounts or charge-off accounts to increase their scores?
That is where I need to see them. Because as I was saying earlier, collections are all about the dates. And I know a lot of people see the date reported and think they're getting updated. The date reported just means that someone did a dispute and the bureaus updated the information. The only date on collections that's important is the open date. So when I go through a report, I look at all the collections. You want to look at the open dates. It's the newest collection that hit them the most.
All right, my friend, that's it. I'll let you go. Thanks again. I appreciate everything you do, my friend.
All right. Thanks, you guys. Have a wonderful day.
All right, take care. Bye-bye.